There's no substitute for reading the textbook, including these mini lectures. My purpose here is to glance at the key topics contained in the Don't Miss This reading guide for each of the assigned chapters, to keep you focused on important questions which you yourself should raise and answer as you do your textbook reading. Let's look at this reading guide for Chapter 1. The chapter notes that accounting is an information system which captures economic events that affects the financial condition of a business, which is the status of assets on the left-hand side of the equation and the status of liability positions or equity positions as measured on the right-hand side of the equation. The accounting profession has adopted a set of generally accepted accounting principles and assumptions which guide how economic events are captured and reported. This is abbreviated as GAAP and effectively defines the rules of accounting. An important principle is the cost principle, which dictates that acquired assets be recorded at their cost basis. Another key assumption is known as the economic entity assumption on page 10. This assumption means that assets coming into the business are owned and controlled by that business and not the party that brought them in, even the owner. The owner will have a claim against business assets they contribute, but their ownership becomes the business as a separate entity, and owners should not use business assets for personal use. They are meant for business purposes. That's the meaning of the economic entity assumption. The underlying equation, which defines financial condition, is both introduced and demonstrated in this chapter. It's vitally important for you to understand how economic events, known as transactions, are recorded within the equation. As assets are increased on the left, some position must be increased on the right side, and vice versa. As assets flow out of the business on the left, some position on the right side is correspondingly decreased. You will express these changes in simple plus and minus changes to keep the equation elements in balance. The chapter summarizes how financial condition is reported: an income statement, an equity statement. Both of these are captured on the right-hand side of the equation, and a balance sheet statement, which is the accounting equation itself, reporting the ending balances in all asset and liability accounts and the ending balance of the owner's net worth, which is known as the owner's capital account. A fourth statement is the cash flow statement, which is not covered in detail in this course. I'd like to call to your attention a separate handout in the Momentum Contents area entitled Recurring Cycles of Economic Activity. These 5 defined cycles focus on changes in assets. Cycle 1, getting assets. Cycle 2, rearranging assets, not changing them in total, but simply using cash to, say, buy land, building, or equipment. Third cycle, using or consuming assets. A fourth cycle, very important, creating new assets. This is the lifeblood of businesses, growing assets through making sales. And finally, the fifth cycle, returning assets to owners. These are known as withdrawals. It will be most important to you to spend 10 minutes to demonstrate to yourself the effects of each side of the accounting equation for these 5 cycles. Keep in mind the equation, wealth or assets on the left, and reasons and measurements why this wealth exists on the right. So assets on the left and their accountability on the right. Please take the time to look at the effect of the equation for each of these cycles. The financial condition, assets, positions, liability positions or equity capital, getting assets, increases it on the left, and some accountability must be increased on the right. As mentioned, rearranging assets does not affect asset values in total and therefore does not affect the accountability side of the equation or the right-hand side. Using assets up, paying expenses, cash may be decreased, and we reduce the equity portion of the owner's net worth on the right-hand side. Creating new assets, cash may be increased, and we increase the net worth of the owner in his equity section by use of a revenue account. And finally, returning assets to owners, cash is reduced, for example, and we reduce the net worth of the owner on the right. As you proceed through your reading of the chapter and the assigned homework exercises and problems, I expect you to send me clarifying questions via Momentum email. Please stay in contact with me to ensure you are tracking on the material presented in the text or in handouts made available in the contents section of Momentum.